Hello, this is Professor Hazara again, and this is the final lecture, final topic in advanced accounting. And we're just going to dedicate one day to this, and it's going to be part of the final, but it's on the basic aspects of pension plans. Okay, now here's what we're going to look at in this video. Number one, actually, there's going to be two or three videos, short ones. This particular presentation will describe two types of pension plans: defined contribution plans versus defined benefit plans, the components of defined benefit plans. Now, just to give you a little bit of head start here, defined benefit plans are much more complicated than defined contribution plans. And so most of this, the problems associated, the accounting issues associated with pension plans are associated with defined benefit plans. And so after defining the components of defined benefit plans, uh, I'll talk about how to construct a basic pension plan worksheet. That'll be in the next video. And then how to record pension expense. So it looks like we're going to have two videos. The first two, this one is we're going to talk about defined contribution plans versus defined benefit plans, talk about the components of defined benefit plans, then we'll have a video on how to construct a worksheet. Okay, so the two types of pension plans. Defined contribution plan. Okay, under defined contribution plans, the employer contributes a fixed amount to the pension fund. That is where the employer's obligation stops. So think of your pension plan. The think of, the employer puts money into it. It could be some sort of brokerage account. It could be a fidelity account, whatever. But the employer puts a fixed amount into that plan every pay period, and that's where the employer, under this type of pension plan, that's where the employer's obligation stops with the contribution. That's what they call defined contribution plans. So the employer puts a fixed amount in there. The amount of benefits that ultimately come out when you retire are your responsibility. So the employer's responsibility, legal liability, and risk stop with the contribution. Okay, so under this type of plan, the employer contributes a fixed amount to the pension fund. That is where the employer's obligation stops. The ultimate return provided by the plan and benefits paid out are the responsibility and risk of the employee. And that's why there's so many pension fund managers, et cetera, because once the money's there, it's up to you to manage it. The company does not manage it for you. Okay, the most common version of this plan is a 401k. 401ks are defined contribution plans. Your employer puts the money in there, and you're responsible for managing it and the ultimate benefits paid out. That's different than defined benefit plans, which are more complicated. Under this type of plan, the employer contributes a fixed amount to the pension fund. That's to the pension fund. However, the employer also guarantees the return on the plan assets and the ultimate benefits paid to employees. So the employer does two things here. Number one is they take money out of your paycheck and they put in a matching contribution and they put it into a pension fund. And even when it's in that pension fund, they manage the pension fund and they're responsible for the level of benefits. They guarantee the level of benefits that you will get when you retire. So their liability doesn't stop with the contributions they put in. Their liability goes all the way to guaranteeing the benefits that retirees receive, which could be many years from now. Okay, thus the risk of this plan lies with the employer. So the employer, if the plan has to return a certain amount, that maybe have a 10% return, in order to pay a certain level of benefits. If the plan doesn't return a certain amount, the guaranteed return, then the employer has to make that up. This type of plan are usually generally state pension plans. I believe Rhode Island would fall into this plan, not for the professors, but for other state employees, and traditional corporate plans. By the way, this type of plan used to be the standard plan, but employers like defined contribution plans now because they have benefits there. They just put in the money in it and they don't have any more risk. Okay, so let's do an illustration here. Here's two examples. Okay, defined contribution plan. Okay, so let's assume that a company has a pension plan under which the company contributes $1,000 to the pension plan / fund. Let's assume two scenarios. In one, the pension plan earns a 10% return. In the other, the pension plan earns 5%. Now, each of these two scenarios can be illustrated as follows. Okay, so this is scenario one, really. You have the company, and the company contributes $1,000 to the pension fund, and the pension fund returns 10%. Okay, so at the end of the year, whatever, the pension fund, or the end of maybe the entire career, the pension fund will then have $1,100 to distribute to the employee. And what happens then is when the time comes, the pension fund pays the $1,100 to the employee, the retiree in this case, and the retiree gets $1,100. Okay, so that's the basic setup for all pension plans. You have a company, the contributions go into a pension fund, there's a return earned, and then the benefits come out, including the return. Now let's look at the 5% scenario. The company, the same type of thing. The company pays $1,000 into the pension fund. The pension fund returns only 5% in this case, so the pension fund will accumulate only $1,050 rather than $1,100 here, and then ultimately those $1,050 are paid to the retiree. Now, the big difference between these two scenarios is that here it is. The liability stops with the contribution. That's why I say there. The liability stops here with the contribution. The employer's, I maybe should have said the employer's liability stops there, is under both scenarios, the employer contributed $1,000. That's all they have to do. In the first scenario, it returned $1,100 and the retiree got $1,100. That's good. In the second scenario, the plan returned 5%, which gives the retiree $1,050. So the retiree got $50 less. The employer in this case doesn't have to worry about it. The employer's liability stops with the contribution that's made. In this type of pension plan, the employer liability stops with the contribution made. The return and thus the level of benefits is the responsibility of the employee. So the employee, years before retirement, hopefully, has to manage that pension fund. The employer doesn't care. Okay, now let's use the same scenario, a defined benefit plan. Let us assume that a company has a pension plan under contract, plan contract under which the company contributes $1,000 to the pension plan fund and is obligated to provide a 10% return. So in this case, it's the same scenario, but the employer has to provide a 10%, as to guarantee a ultimate 10% return, and and um, and ultimately the 10% benefits, the $1,100 benefits. Assume two scenarios. In one, the pension plan earns 10%, and the other, the pension plan earns 5%. The plans can be illustrated as follows. In a way, now, this unifies the plans because the employer has to guarantee the ultimate return. Okay, so in this case, you have a company. They contribute $1,000. The pension plan pays $1,100, and the retiree gets $1,100. So that's normal. But let's say the pension plan only pays out, there's a contribution that pays out 5%. Okay, the contribution, there's a $1,000 contribution, and the pension fund earns 5%. So that gives you, I should change that here to $1,050. Okay, I'll let that go without making another video or inserting something. Okay, so we'll put this up again. So the pension plan pays $1,050. Okay, so the retiree would get $1,050. Okay, however, you'll see in this last thing here, I have $1,050 plus $50. Now, why am I adding $50 to it? I'm adding $50 to it because the liability in this case doesn't stop with contribution. It goes all the way to the benefits. And if the plan guarantees 10%, and that's the assumption there, then what the company must do then is they must give the retiree somewhere along the lines, either put it into the pension fund or give it to the retiree $50. They make up the $50 difference between the 5% that was actually earned by the fund and the 10% benefits that they've guaranteed. So in the last sentence there it says, in this type of pension plan, the employer's liability includes the $1,100 benefit. If the return is insufficient, the employer must contribute the difference or accrue a liability. So really, more realistically, the employer would probably put that $50 into the pension fund, and then they would transfer over $1,100. But the point basically is that somewhere along the line, the employer is responsible for the ultimate benefits. Okay, now This plan, as you can see, would probably create a lot more accounting complexities than the defined contribution plan. Okay, so that means that there's a need to define certain components of the need to define certain components of defined benefit plans. Really, the expense associated with defined benefit plans. Okay, so let's start out with the simple part. The accounting for defined contribution plans is simple. In the above example, the entry to record pension expense in either scenario would be debit pension expense, credit cash. And that would be because thinking back to that example, it doesn't matter whether the plan earned 10% or 5%, the employer's liability stopped with the $1,000. And so there's your journal entry. You don't have to worry about anything else. However, the special nature of defined benefit plans requires that 5 components of pension expense be defined. I'm going to give you 4 here. There is a 5th one, but I'd rather not get into it, so we'll just look at 4. Okay, so here are the components of defined benefit plans. Number 1 is called the service cost. This is the contracted amount that the company must pay into the pension plan each year. This is part of their liability. They're liable for both the contribution and the return. Okay, in the example above, this would be the annual $1,000 annual contribution, loosely speaking. Interest costs. This is the contracted annual interest rate that the plan must earn. In the example above, this would be 10% or $1,000 times 10 or $1,100. Okay, so under defined benefit plans, you're looking at basically 2 things. Number 1, the company is responsible for making a contribution, and they're also responsible for the return earned by a plan, and that's called the interest cost. So those are 2 components of pension, defined benefit plan expenses. Okay, the next one is sort of a negative cost, the actual return on plan assets. This is the return that the plan assets provide. Okay, in a sense, in the example above, this would be the 5%, $50 that the plan earned. Now, if the actual return is lower than the interest cost, the company must contribute the difference or accumulate a liability, which is what I said before. If the plan doesn't earn enough, you either have to record a liability, which means that your plan is underfunded because you owe it money, or give it money now. Okay, now those are the 3 fundamental components of pension plans, defined benefit plans. There's a final one which should be included in here, which is kind of unusual, but I'll show it to you in the next video, which is the worksheet example. Okay, something called prior service costs. Okay, this is an expense which is incurred when the company pays a special pension to individuals, usually high-level executives. A lot of times, companies will amend their pension plans in midstream to accommodate a high-level executive. Maybe they're hiring somebody new, and they say, or they've just promoted somebody, usually high-level executives, and they give them a huge bump up in their pensions for all the years of service they worked. That's why it's called prior service cost. It usually for big promotions for high-level executives, and it's usually for prior years of service that those executives have worked, and it's usually a large amount. And what happens, these can be large, so they're treated as prepaid assets for the years worked when they're awarded, and then they're amortized like a prepaid expense. Okay, now let's go to the Excel worksheet. This will be next video. We'll look at how to put together a defined benefit plan pension worksheet. Okay, I'll stop here, and then we'll go to the next video.